Hey everyone, I'm making this video to walk through the homework for chapter 5 and hopefully give you guys some help on this one. And yeah, let's get started. Oh, I did start to go over question 7 already in class, so that has some of the numbers built in, but let's go back to question number 1 to begin. Okay, so we're going to be looking at a lot of accounting adjustments essentially in this chapter. And all that good stuff. So let's start with this question. We've got Salmon Fisheries is owned. We have a typo there. Is owned by Mark Ashmore and provides fishing products to the fishing industry. And at the end of May 2024, we have the following adjustments that we need to make. So I'm going to take a quick snip of this information on my second screen. Make it easier for me to see, and then not have to scroll down so much. So a few things to note here. Let's see if I can move my screen a little smaller too. Yeah, so we can see the whole unadjusted trial balance. So this is our ending trial balances. Note that debits equal credits. So this is, if we think back to the earlier chapters, this is like if you did all your T account work, you've got ending balances, then this would be the ending balance for all of the accounts essentially. So you've got assets up here, you've got liabilities here, you've got equity accounts here, capital withdrawals, and then you've got income statement accounts with service revenue and some expenses here so far. And you can kind of see we've got open spots in these areas here for some of the adjustments. So just something to note there. So the first transaction that we have noted above on our list here is that account of office supplies showed that there was $450 worth remaining in the office. And so we started here with our 1,640, but once we did our physical count and went out and actually looked, we realized that there's actually 450. So basically we need to adjust that 1,640 down to the 450. So the difference between those two is 1,190. So we're going to go, and this is a debit, it's an asset, right? So a debit normal balance. So to reduce an asset, we want to credit it. So we're going to put 1190 in for our credit. And then the other side of the reduction in office supplies is going to be office supplies expense, right? Because those office supplies were used up during the month of May or whenever this time period was, since they last did, say, for example, an inventory count or some purchase or something to get this balance on there. So, okay, that's the first adjustment. The second one, the balance of prepaid insurance is for a 7-month policy, and 1 month has been used. So if we look at prepaid insurance, it's $8,400. And they're saying that is 7 months left. So divide that by 7 means that there's 1,200. So 8,400 divided by 7 is 1,200. So essentially, the way we're getting there is there's 7 months left. This represents 7 months. And we're saying that 1 month has been used up. So we need to show only 6 months now. So 6 months, if we take the 1,200 per month, figuring that it is, do 6 here, just calculate it, 7,200. So if this represents 7 months and we want to use up one of those 7 months, we divide this number by 7 to give us 1,200 and then pull that portion out of it basically. So we're going to end, I guess I should put my adjusted trial balance figure in here. So this, minus that, and same down here. So our office supplies expense. But we're going to reduce our prepaid insurance by 1,200. We're going to go in here with insurance expense for 1,200, and that will leave us with 7,200. And just like we were just saying, the 7,200 represents 6 months, and that would be 1,200 times 6, right? And we figured that out because 8,400 divided by 7, because it's a 7-month policy, gives us 1,200. So there's like 1,200 increments, 1,200 increments to get us to the total of 8,400. One of those is used up in this month of May. So we're left with 7,200 now. And that's now 6 chunks of, $1,200 value basically to represent 6 months left on the policy. And yeah, and the way we're getting across to the adjusted numbers is just that's the ending result and the correct adjusted value, right? So this needs to be 7,200. If it showed 8,400, and that that would be incorrect because that would represent 7 months, whereas we've used one of those 7 months up in May. So we need to show the ending balance as 6 months, which is $7,200 of value left for that period. And same thing with office supplies. If we left it at 1,640, we just did a count and we know it's actually 450, not 1,000. So that would be wrong. So that's why we're making these adjustments and ending up at the correct balances, right? That's kind of the whole point of the adjustments. Okay, the next one, during May, salmon fisheries earned 510 of unearned revenue. So remember, for unearned revenue, we've got, it's a liability account, right? So we earned $510 of this 6,000. So if we walk back a little bit, to see how we got to 6,000, at some point that means that we were paid cash, we were given cash, and we recorded entries into unearned revenue to get us $6,000, right? So just logically thinking about this, like you've got this money, you haven't yet, earned it. But you have now earned $510 of it as of the end of May, because you've completed some portion of work that, represents that value basically. So we need to reduce this by 510 because that portion of it is no longer unearned. It's now earned. So that leaves us with 5,490. So 6,000 minus 510, 5,490. And then it's service revenue here. So that's going to be I put that in the wrong spot. This is a debit because it's a liability. And then service revenue is going to be our credit there. Okay. And then that leaves us, so 4,950 beginning plus 510 of earned revenue leaves us with 5,460. Okay. So that is good. All right, and our next, next and final adjustment. Computers were purchased on May 1st, 2024. They have an expected useful life of 5 years with no residual value. So remember to calculate our annual depreciation, and then we can go to monthly if we want. And we do want to go to monthly in this example. So we could do a couple things, ways to get to monthly. We could take, so the 15,000 represents, it tells us in the problem here, it's 5 years. So if we take 15,000 divided by 5, we get 3,000. So it would be 3,000 of depreciation expense per year. And if we want to get to monthly, we can then just divide by 12 to get us to $250 of depreciation expense per month. And it says we bought them on May 1st, so 1 month of depreciation has occurred basically in May. So we don't want to reduce computers directly. Remember, this is the contra account of accumulated depreciation. And so what we want to do is put our 250 in there. Remember, and then we reduce computers minus the asset minus the accumulated depreciation gets us our net book value. And then the other side of this entry is going to be depreciation expense. So 250 there. And yep, that's all of our adjustments. I think we've got them all Oh, sorry, I'm gonna put that carry it all the way through. There's that one. And so that basically is all of our adjustments. And then we just want to go in, and for the accounts that don't have adjustments, we just want to carry these over. Oh, make sure you put the debits in the right spot, the credits. So we're just carrying, these are credits for equity, and we're putting them in the credit column. Accurately, debits for the withdrawals. Should I just go through all these real quick? Let's check all of those. Cool. I think we've got everything in there other than the totals. So then we just need to add up all the new amounts here. Per my calculations, it's $34,950. This should be the same, so let's just hit our check button to find out. Sweet. We're missing something. What are we missing? 93 out of 100. Computers. Earned revenue? No. It's payable, capital. That all looks right. What am I missing? Do I need zeros in here? I'm assuming I don't. Let's check though, just make sure that's correct. Yeah, it's not those. I'm just going to go put zeros in everywhere just to see, because I'm not sure. I'm not seeing what I am missing here. So maybe if we put a zero in somewhere that they're saying is supposed to have an answer, it'll help show us what I am missing here. I don't know. That's weird, because I'm getting 0.93 out of 1, but I don't see anything marked incorrectly. Let me add my credit side just to make sure that actually balances. So I'm just adding up all the adjusted trial balance numbers. Yeah, that gives me 34,950. I don't know. Okay, well, I'm not sure why that one's showing 0.93. I wonder if it might have a error in the homework or something like that. That's weird. So you guys get slightly different questions than I do on these, so I may, hopefully you guys don't run into those same problems, I guess. But oh, I know what it is. Sorry, there it is. I see now. The one thing I didn't do correctly, I got to add my adjustments here, my debits and credits. Yep, that's the problem. There we go. Okay, so we want to add up our 510, 250, 1200, and 1190. So add up all the debits and credits, because it's not zero. There will be an amount for debits and for credits. So 3150, and it should be 3150. Your debits and credits should equal. All right, that's great. Well, apparently putting zeros in does not mark those ones as incorrect. So I guess that's not a working strategy, but yep, sorry about that. I forgot about that little piece. Okay, that gives us 100% on that problem. And let's move on to the next. Okay, question number 2. Chirp Hearing is owned by Annie Janner. It provides hearing aids, yada, yada, yada. At the end of September 24th, we had these adjustments, and again, we've got an unadjusted trial balance that we need to make adjustments into. Great. Okay. Well, let's take our. Let me snip this again. Pull this over. Okay. So the first adjustment tells us that we have. Put this in my. Excel here. Okay, so we've got Chip Hearing is owned by Annie Janet and provides hearing aids and other auditory services. And let me try to let me show you my Excel while I'm doing this, and then we'll come back to the homework spreadsheet here so I can show you how to calculate these out in a little more detail. So let's do that now. Hey everyone, let's take a look at the accounting adjustments here in an Excel spreadsheet format, and we can kind of just talk through how we should be thinking about these and calculating them out. So yeah, let's start with the first one basically, which I have right here, and that's this line here. So interest on the bank loan is set at 10%, and 1 month of interest has accrued. And so with this one, what we want to do is we want to take our outstanding balance in notes payable here, which is $6,100 per the unadjusted trial balance. There's a 10% interest rate is what it tells us, and 1 month of interest has accrued. So to get 1 year of interest, we take our $6,100 times the 10% rate. So total interest expense for a full year, if that balance, outstanding notes were to stay the same the whole year, would be $610. And then to get the monthly, we're just going to divide that by 12. And it tells us in the problem to round to the nearest whole number. So instead of 50.83, we'll have 51 of interest expense on this outstanding notes balance per month. And we have a 0 balance in interest payable currently. And so when we go to make our adjustments, we're going to put an adjustment to record the interest expense, and then we'll increase our interest payable by 51. And since it started with a balance of 0, we're expecting it to end in the balance of interest payable to end at $51 in the adjusted trial balance. Okay, the balance of prepaid rent is for the remaining 7 months of the lease. Sorry, my dog's sitting on my lap too, by the way. So if you hear licking sounds, that's him, not me. All right, so for the next one, prepaid rent is for the remaining 7 months of the lease, and 1 month has been used up. And so if we look at our unadjusted trial balance, the prepaid rent balance is $8,400. And that represents, it tells us here, 7 months. So each month then, just taking that, $8,400, which is in the unadjusted, and they're telling us it represents 7 months. And so we take that, divide by the 7. So this is $1,200 per month of prepaid rent expense. And 1 month has been used up here. So then we're going to take we're going to reduce this current balance by 1 month's worth of $1,200. So 8,400 minus 1,200 of 1 month less will give us 7,200, and that's 6 months of the lease. So if you were to take 7,200 divided by 6, you'll get the same amount, right? 1,200 prepaid rent left over, which is 1,200 of prepaid rent each month going forward for 6 months, which that's what you expect, because it should be the same amount each month for the full balance of the period basically for the rent. So when we book our adjustments, we're going to want to record a $1,200 rent expense, and we're going to want to reduce the current $8,400 down to $7,200 to represent the 1 month's worth has been used up. Okie dokie, so that's the second one. Then we have a one about depreciation. So we have equipment that was purchased 3 months prior at the beginning of the month, and will have a useful life of 7 years and no residual value. Depreciation is recorded each month, and recorded depreciation for September. So Here's some of my calculations on this. So if we look at our unadjusted trial balance, you've got $18,480. You've got no residual value. That leaves us, if we did have residual value, this number would be lower, obviously, because I wanted to put it in here to remind you guys just of that formula, which is this minus, the historical purchase price minus residual value gives us the starting point for our depreciation calculation, and then you want to divide by the life to get total per year. So we are dividing by 7, as it tells us here, per year. So $2,648 of depreciation expense per year. And then we want to get it down to months. So we want to divide that by 12 months. So it should be $220 of depreciation expense per month. And it tells us that we bought it 3 months prior. So there's a couple clues here. And then we look at the unadjusted trial balance, and it shows accumulated depreciation of $440 before we book in this month. And so we can kind of like reason through that. Makes sense. So we've so far recorded 2 depreciation adjustments for $220 in the 2 prior months. So we don't really need to worry about the expense side. This is what the current balance is, because it's the cumulative result of the 2 months being recorded. And then we're just going to record one more in to end us up at 660. So when we book our adjustment for depreciation, we expect to have the 220 of depreciation expense, and we expect to have accumulated depreciation end being 660, which it will be, as it's currently 440. We add in the 220 more expense, put it in the bucket, and we've got 660 ending balance. And just as a side note, that our net book value then at that point, I'll just take this, would be the 1840 purchase price minus the current, after we book this adjustment, it'll be the 660. And if we take the 18,480 minus 660, I did a negative, so positive plus a negative, we should have we'll have a net book value at the end of September of $17,820 in our for our equipment. All right, 2 more. This one, chirp hearing, completed $680 of work that was previously unearned. So in this one, we look and see that we have $2,300 currently in our unearned revenue unadjusted trial balance. So just remember, thinking back a couple steps, at some point, a customer paid us a deposit or prepayment of $2,300, but we got the cash for that, but it was unearned at that point because we hadn't done the work or whatever it was that would earn us that money. But in this instance, it tells us right here that we did $680 of work during this month. So we have earned that portion of the original $2,300. So we're going to want to record revenue for that piece because we earned it. And we also want to reduce our unearned to indicate that the residual portion that's not earned now is just $1,620. So $2,300 minus $680. And so for the adjustments, we'll record, I just kind of said revenue of $680 and reduce our unearned revenue down to $1,620. Finally, office supplies used during the month total $230. So if we look on our unadjusted trial balance, it shows $1,470, and we want to show that we used up $230 of office supplies during the month, and that means that we're going to have an ending balance of $1,240 of office supplies left over. So for our adjustment here, we'll record $230 of office supplies expense, and then we will reduce the office supplies asset account down to what it should be, $1,240, since we used up $230. And remember, in these problems, a lot of times they won't just tell us how much was used up. They'll tell us, for example, you did an inventory count, or you counted your office supplies and saw what was left, and it would show 1,240 left. And so then you'd have to just do the math to say, okay, started at 1,470, but now, at the beginning of the month, we went and counted how much was left at the end of the month. It was this much. Then by logic, just subtracting the difference between these two is 230. And then you would know how much was used that way. But this problem just straight up tells us here. So, just different ways to look at it. And so now that we know all of our calculations and adjustments there. Then we're going to be able to go back and put those into our the homework spot then. Let's see. Okay, bear with me. All right, so now we're back to the actual input screen for our homework after we've done all of our adjustments. And so we know what all the values should be. Now it's just a matter of going in and putting in our adjustments here. So we'll just go line by line. There was no adjustments for cash. There was no adjustments to accounts receivable. So I mean, you can envision like 0, 0. This just carries over. But prepaid rent, we did use up, remember 1 month of the prepaid rent. And so we want to reduce that by $1,200. And now will leave us with a balance of $7,200 in prepaid rent. We want to reduce our office supplies by $230, which will leave us a balance of $1,240. And this is all the things we just calculated. Remember, we don't adjust our equipment account directly, but we want to increase our accumulated depreciation by $220 and leave us with a balance of $660. There was no adjustment to accounts payable. Interest payable was $51. And it was basically 0 to start with. So, add those all the way across. Credit plus the credit ends up with the credit balance. We reduced our unearned revenue by $680. And that will leave us with a balance of $1,620. So a credit, the debit will reduce the credit and leave us with a credit balance of $1,620. Notes payable, we had no adjustments there. We had the interest payable, but there was no principal payments to change that $6,100 balance. $1,800. For service revenue, we had, that was the other side of this, of the unearned revenue. So we'll add $680. And we'll say $680 plus $9,300. So $9,980. And then we had depreciation expense of $220. And that was the other side of the accumulated depreciation entry. We had rent expense of $1,200, which is the other side of the prepaid rent, the rent expense portion. We had interest expense of $51, which is the other side of the interest payable. And we had $230 of the office supplies expense, which is the reduction in office supplies. And nothing for insurance expense or salaries as far as adjustments go. So now we just need to add all our things up here. So we've got 680 plus 220 plus 1200 plus 51 plus 230. And that totals up to, I get 2381. It should be the debits and credits should equal. So let's check ourselves here. Nice. Okay. So we're looking good so far. And then let's just add up our unadjusted trial balance numbers. So starting with 4,000. So 4,000 plus 1,600, 7,200. Just going down the line here, adding up all of our debits. If we add those all together, I get 39,140. And then our debits and credits should equal, so let's just put that in and see if it works out. No, what did I miss? I missed a couple. Sorry. I didn't carry these through, right? So remember, you got to carry over all the balances to your adjusted trial balance. Let's try this. 4621. Nice. There we go. Perfect. Should be 1 out of 1. Yep. And that'll be 100% on that problem. Okay. Let me get my dog off me. Put blanket far down. It's not helping me make this video. Okay. Next problem. Question number 3. Okay, so Mr. Kara operates an advertising business called A Advertising. He has following adjustments for December 2024. Okay, so let's do the same thing again. Where I'm going to take this to an Excel and kind of show you guys the calculations, because I think that is actually really important to understand, and me just verbally explaining it to you while I'm putting numbers in here, I think kind of would be a disservice and not fully explaining the calculations that need to go on to get your journal entries. So I'm going to switch over to my Excel now and we'll do the calculations. All right, so let's look here at the various adjustments we need to make. So we're going to recognize $2,350 of rent expense. And one thing to note for this problem, we don't have to do the unadjusted or adjusted trial balance spreadsheet, the whole 6-column spreadsheet deal. So we're just doing the journal entries on these. So we don't have to do quite as much work on these. So if it tells us we recognize $2,350 of rent expense used for the month, then we're going to just record $2,350 of rent expense, and that would be rent expense. Or let me do it like a journal entry style. So if we just do rent expense, and then this would be prepaid rent is our credit. I'm going to indent that a couple just to show that that's the credit. And so that would basically be it. And the way that there's one little thing to kind of look at here and think about is since we don't have an unadjusted trial balance, we can't see what prepaid rent was before we make this adjustment. But the clue here is that we're saying it doesn't say we paid $2,350 of rent. It says we used, rent expense was used for the month. So that kind of is a clue that it is a reduction in prepaid rent. It's just something to think about. But yeah, no real big calculations because it already just tells us what it is right here, basically. If it said like the balance was $8,200 for 8 months and we used up 1 month, then we'd have to do all those calculations again. But it just straight up tells us here. So good to go with just knowing that. A monthly magazine subscription was prepaid on December 1st, 2024 for $5.52, and 1 issue had been received. December 31st, a monthly magazine prepaid. So I'm assuming what they're saying a monthly magazine is prepaid. I'm going to assume it doesn't really tell us exactly, I guess, in this one. We might need to look back at the problem, but I'm going to assume that that's an annual amount. The 552 represents a full year of subscription service, for magazines or whatever. So that part's a little vague actually on that. I think they kind of missed a monthly magazine doesn't tell you how many months it exactly is. So whatever. But anyway, this first entry that we would have made on December 1st, right? So I'll just do it like this, 12/1. This isn't what it's asking for, in this homework to input right here, but just to show you guys like what the original entry was to book the, I'm just doing bear with me here. Okay. Just to record that, you would have had prepaid magazine expense basically, right? And then you would have had cash. And that's what this transaction originally would have been. And it would have been 552, and that happened on December 1st, right? So we got our prepaid total balance because we paid that full amount, and we're assuming this represents 1 year, which I think is the right answer, but it doesn't exactly tell us. But I'm going to assume that's it. And so by logic, then this represents, we're assuming 12 months So that would be $46 a month, basically. Kind of expensive for a magazine subscription, I guess, but I don't know. That's what it is. I think we'll check it. It just, yeah, it doesn't tell us exactly how long. Make more sense to me maybe if that was like 2 years, but anyway. So then when we come to 12/31, to record the full month of and this usage, then we're going to record not prepaid here. We're going to reduce the prepaid. So we're going to put this down here. Did that a couple, but we're going to record I'm going to call it magazine expense. In the homework problem, it'll give us specific options to select for which accounts they are. It's kind of a chart of accounts sort of thing with drop downs. So maybe the name's just a little bit different, but anyway, that's the right idea. And then again, we just divided by 12 to record one magazine received. We're assuming we're going to get 12 for 12 months. And this would be what the adjusting entry would be then. Okie dokie. So the next adjustment, computer's depreciation for the month is $1,200. So again, we don't have to do any calculations on this. It just tells us, right? A lot of times we have to actually figure out what these would be, but they're taking it easy on us on this problem and just telling us it was $1,200. So we don't have to do the calculations and all that stuff. But the journal entry anyway, remember your expense, and then our credit will be to accumulated depreciation. December 31st, salaries for employees accrued by $3,330 by the end of the month. So again, tells us what we're doing. So salaries, expense, no calculations really needed there, and salaries payable will be the answer there. And we know that it's not talking about salaries that were actually paid by the end of the month because it uses the terminology accrued. So that is that. And then I think for the last one, let's take a look here. Looks like we might have to do a calculation on this one. Okay, 30-day contract was started on December 15th. Customer will pay $51.70 at the end of the contract in January. So half of it was, so half was accrued. I mean, it's pretty easy math. So let's just divide this by two, gets us $25.85. So so they have not, they'll pay us at the end of January. So we haven't received any money yet. So it's not unearned revenue, but it is an accounts receivable type transaction. It is, earned revenue, accrued revenue, let's call it, accounts receivable. And it's exactly half what's completed, they tell us. So pretty easy math there. So then we can just do accounts receivable. And let's, I'm not sure. We'll have to look at what accounts revenue account says there. So we'll just say revenue. And again, that's just half of the amount earned by the end of December. Okay, so this one didn't have a lot of calculations, after we went through it, but hopefully that was helpful. And now let's just go over and put these back into the actual spreadsheet. Okie dokie. So now we're back on the the input section here, and so we already kind of went through. We've got the rent expense. And let's go prepaid rent reduction. And that's the $23.50. So the 1 month of subscriptions, let's say, subscription expense. And let's go look at our prepaid subscription. So we are reducing this by $46, 1/12. I'm curious to when we check our answers, see if that's right, because it didn't tell us how many months, right? Or how many magazines or whatever. So curious on that one. We'll see if we're missing something there. Accumulated depreciation, it was $1,200. It just told us that. Salary accrual, so salaries expense and salaries payable. That was just $3,330. And then accounts receivable. And yeah, we just have one revenue account, so service revenue in 2585. Okay, fingers crossed. That's it. $46 to an expensive magazine. So that was it. It is, again, they didn't tell us. It just said a monthly magazine subscription was prepaid, and we received. It doesn't tell us that this is an annual subscription or it's 12 months or whatever. So they really should have told us that above. We just had to guess, and that was right. I mean, usually you could probably assume that, subscriptions are for a year, I guess, but I mean, you could sometimes they're not, I think. So, okay. Alrighty. So, again, let's go to our Excel and we'll do some analysis, and I'll show my work here so you guys can follow along for this problem because it's got more of that. Okay, so we're looking here. I snipped the the components of this problem over into this Excel spreadsheet, and let's look at some of the specifics here. So here's our unadjusted trial balance, and then we've got the following adjustments that need to be made, right? So the balance of prepaid rent represents a 12-month lease. So let's look at prepaid rent is $1,800, and that's just this one. I guess I'll put it on the same line there. So you see that prepaid rent, $1,800. That represents 12 months prepayment. I'll just put it, I'll put it 12 and then I'll just say months. So this prepayment, you paid it, $1,800, and then that represents rent for a full year. So each month, just dividing the full year divided by the amount of months. So each month the rent is $150. And so we're saying 1 month has been used up. And let's say rent expense per month. And so at the end of this month, because we've used one up, it's no longer $1,800 of prepaid rent per the unadjusted trial balance. It's going to be $1,800 minus the 1 month that was used up. Now it's $1,650. And that represents 11 months. So so then we'll call it adjusted prepaid rent. So we want to reduce our prepaid rent by $150 to bring us to $1,650. Okay. Depreciation of equipment for the month is $690. So that there's really no calculations there. It's just depreciation expense and accumulated depreciation, which we don't have those accounts yet. So that's kind of something to think about, is if you don't, like if you were, the real accountant, you're doing this work, you would have to create those accounts essentially. But we'll have to put those in somehow. So I'm assuming it lets us, once we hop back over to the actual homework, there'll be a way to create those accounts to put the amounts in. And then finally, magnitudes, and we don't have to do any calculations, it just tells us what it should be. So that's great. Okay, magnitude services has earned $1,560. That was previously unearned. So here's our unearned revenue here, $44.60. I'll do this. So unearned revenue per the unadjusted trial balance, $44.60, and we earned $1,560 of that amount during the month. So it's no longer unearned. Now it is earned. So we're going to reduce that unearned balance, and we'll say revenue earned, and then adjusted unearned revenue, $2,900. So that's about all that one. That's the three adjustments. I mean, there's the three adjustments. This one, the depreciation, we didn't actually have to calculate it. It just told us what it would be. But we do need to figure out how to make those accounts to represent accumulated depreciation and depreciation expense. So I'm going to hop back over to the homework now. Okay, so this one, so we're just putting the journal entries in too. So that's one thing to see. So we don't need to create new accounts because we're not showing the actual 6-column adjustment
spreadsheet. But we are going to use accounts that are not specific, that don't specifically have balances yet, which would be depreciation expense and all that stuff. Just something to keep in mind. But we already did, so we did our calculations. So our rent expense was 150. Now we're going to reduce prepaid rent by that same amount to represent 1 month used up. Depreciation, it just, like I said, just tells us. So we're debiting our depreciation expense and crediting accumulated depreciation, which is, it's 690. Again, it just told us what that was. And then earned revenue, we're going to reduce our unearned revenue. Oh, here it is. I don't see that account. By 1560, and we're going to record revenue because it was earned. We're reducing a balance sheet account, right? This liability gets reduced, and we recognize on the income statement that we did earn that those amounts. 1 out of 1. Okay, that was everything on that problem. Okay, so now we've got more calculations, I think. I'm just looking at these real quick. I think I'm just going to go. I mean, we've looked at quite a few. So this one, it doesn't have too many calculations. It tells you most of the information. So I'm not going to switch over to Excel for this one. We'll just go through it with the adjustments. So let's just start. So depreciation on equipment for the month is 330. So it tells us what that is. So 660, and then 660 credit balance plus 330 adding in will give us 990, right? And they just told us, usually if it's a 7-year life and this amount, you got to calculate it out. Just tell us here. So prepaid insurance of $600 has been used up this month. So $600 reduction in our prepaid insurance asset leaves us. So it's a debit. This is a reduction. We're going to go to the credit, or a credit to reduce it, and leave us with $1,000 balance. 1,600 minus 600. Debit, credit minus, subtracting it, reducing it, ending up with a debit balance of 1,000. Okay, next, interest of 140 was accrued on the loan balance, so 140 of interest expense and 140 of interest payable. And that just carries over. There was no interest payable to start with, no other interest expense, so that just goes over. Let's do the insurance expense of 600. That just carries over as well. There's no other balance to start with to add on to it. 600, 600, 140, 140, 330. And there we go. I'm missing one. Yeah, depreciation expense of 330. And then unearned revenue of 930 has now been earned. So revenue is going to go up by 930. 930. And we already had 3,400 in revenue recorded. And that's going to be 4,000. So we end up 3,400 credit balance plus add on more revenue with another credit leaves us with $4,330. And that's the revenue side. And then we're reducing our liability of unearned revenue by 930. It was originally 7,000 minus 930 leaves us with 6,070. So credit balance, subtract a debit to reduce that, leaving us with a credit balance of 6,070. And I think that should be, we got 600. All of them just may go through and make sure we got debits and credits for everything. That all looks good. Let's sum up our adjustments column. So 930 plus 330 plus 600 plus 140. So adding all those up, I get 2,000. Let me just make sure that's all looking good. Okay. And then we just got to finish out our adjusted trial balance by just carrying over all the the balances that weren't adjusted, basically, right? Oh, sorry, I put that as a debit. That should be a credit. Gotta carry down the number. Rent expense. I don't think it said anything about rent in this one, right? Yeah, no. Okay, and then again, we're just gonna sum up. So 85 times 70. Let's check ourselves. Sweet. So that's right. And then it's going to be, we got to have our debit in our credit columns. And looking pretty good, but we're missing something because we only have 0.91 out of 1. So somewhere, it looks like we are missing something. Advertising expense, depreciation expense, that's there. Service revenue, yeah. What am I missing? Credit plus credit, 990, 6380. Oh, no, that's good. What are we missing? Let me add up my credit column just to see if that actually. That's the kind of the risk you run of assuming that it's just going to balance. But if we do that, oh, I get it. Yeah, these all add up to 85,170. These all add up to 85,170. This is the 2,000. But one thing I can see is if we started with 84,700 debit plus debit to debit, there isn't something not adding up there. So it should end up with 86,700. So I am missing something. I just gotta figure out what it is. Well, no, because that could be a reduction there. Oh, derp. It's got headers. Stinking headers. Oh, man. You know me and the headers. It's kind of goofy to. Hey, I did it right. Company name, spreadsheet, date. There we go. Now we're doing it. The headers. Okay, so that's great. Looks like this is another one. And yeah, this looks real similar. So let's put our headers in first. So that doesn't trick us into thinking we're missing something when we're not. Annoying. And okay, so the amount of insurance is for 12 months. 1 month has been used. So let's look at prepaid insurance. So let's say 1,800 divided by 12 is 150 prepaid insurance. And we used up 1 month's worth. So we're going to reduce that by the 1 month or 150. 1,800 minus 150 is 1,650. So that's our ending adjusted balance there. Depreciation for the month on equipment was 120. So we're going to increase accumulated depreciation by 120. And we had some depreciation expense. That's interesting. Okay, so 360 plus 120 is 480.
strange. It's weird that here's just something that's odd to me is that they would have depreciation expense, but there's no accumulated depreciation. So that I think they made a mistake when they were creating this problem with that, but whatever. We're just going to go with it. Unearned revenue is $690 has now been earned. So we're going to add $690 onto our revenue. So $54.30 plus $690. $61.20. Credit plus credit gets us $61.20. An account shows that $870 of office supplies remains. So our initial office supplies was $1580. Remaining is $870. So the difference between those then is $710. So we used up $710 worth of office supplies. And we know that the ending balance there, so $1580 minus $710 gets us to the $870 that they say should be on there. So $710 is the office supplies expense. Okay, and then and then we just carry everything over that doesn't have an adjustment. Equipment. So let's do all that. Oh, prepaid insurance thing. I missed my insurance expense part. So you gotta look back through, make sure you got credit, debit, and credit, debit, and credit, debit, and credit. Oh shoot, yeah, $690 there. So this should be not $2180, but it should be $2180 minus the $690 that we earned to leave us with $1490. Credit minus the debit leaves us with the credit balance of that. 50, 100, 710, 1410. Okay, and now let's just go add up all of our debits and credits. 690, 120, 150, and 710 gets us, I got 1670. Okay, and I got, I check myself as I go. See if things coming along. Okay. And then let's add up all of our adjusted numbers. 5470 plus 1870 and so on. Add all these up. So for my calculations, I got 24,420. Okay, great. And then we're just doing our journal entries here. Well, I kind of wish we would have put those first, but that's fine. So prepaid insurance and insurance expense for $150. Insurance expense and prepaid insurance for $150. And this is just the journals basically that correspond to the adjustments, right, in those adjusted columns. The depreciation was $120. So depreciation expense and accumulated depreciation 20. Yeah. Earned revenue, what was it, $690, I think? Yeah. So we're going to reduce our unearned revenue and we're going to record the revenue. First up, the revenue that we earned on the income statement, reducing our liability for $690. And then $710 for office supplies expense. We're going to record the expense and reduce the asset by $710 for both. There we go.
1 out of 100% on that one. Cool. 2 more problems. Okay, on September 1st, Precision Machinery purchased equipment for $111,000. The equipment's expected to last 5 years, no residual value. December 31st year end. In the year of purchase, the company calculated depreciation for each month the asset was owned. I did this one in class too, so I'll just kind of run through what the answers were. So the original cost of the equipment is going to be just what they paid for it, $111,000. Then we divide that. There's no residual value, so it's minus 0. So 111,000 divided by 5 gets us 22,200. So per year. And then per month, if we divide the 22,200 by 12, because this is per year, divided by 12 gets us $1,850 per month. And then we show that we bought the machinery in September. So the first year, since we bought it in September, just has September, October, November, December. So 4 months of depreciation in that first year of 2024. So 4 times the 1,850 gets us to the 7,400. And then, so again, I'll just say that again slowly. Full purchase price divided by 5 years gets us 22,200. So if you had it for a full year, the depreciation expense would be this. But if you have it for 4 months, it's only this. If you want to think of it as a third, right? 4 times 3 is 12, full year. So if you want to divide 22,200 by 3, gets us 7,400. Or alternatively, you could take the full year, divide by 12 to get per month, and then multiply that number by the number of months that you had it, which is 4. So 22,200 divided by 12 is 1,850 times 4 gets us to 7,400. And then the net book value is just taking our original cost minus our accumulated depreciation. So at the first year, 111,000 minus 7,400 is 103,600. And then each subsequent year that we had a full year of depreciation, we're just decreasing that number, if you will, by 22,200 as accumulated depreciation increases by that much. So 59,200. And remember that if you ever get to 0 net book value, then you just don't depreciate it anymore. It's done depreciating basically at that point, and it carries forward usually either a 0 net book value because you fully depreciated it, or if it has a residual value, it would be whatever the amount is in residual value, maybe 500, whatever that residual, it'll depreciate down to that residual value basically. Sweet. Okay, so that gets us all 100% on that one. And then the last problem here, and I'm going to show you just with this last one. Why don't I just do it in Excel and kind of show you guys exactly how this all breaks down. So let's switch over now. Okay, so I just wanted to show you guys here in an Excel kind of how to break this down exactly. So let's do this off to the side here. We've got 18,000 purchase price. We've got 3-year life. And that, let's do this too. So that equals, let's just times that by 12. We can say it's got a 3-year life or a 36-month life, right? We can say that's the same thing. 3 years is 36 months. And it's nice to know the months because that is something we have to use in these problems. So an estimated residual value of $900. So to get our monthly depreciation, we're going to take our purchase price minus our residual value to get 17,100, and then we're going to take that and divide it by 36-month life to get us depreciation expense per month. Okay? And then it tells us that we bought these on November 1st of 2024. Let's see if Excel will do that. Yeah. And then we're going to say this is 2024, 2024, and now we're in 2025, right? So this is all the, I'm just putting these in as the months so we can kind of see the different. Is that 12? Yep. I'm going to highlight these just so we can see the little differences here. So we'll say here's the first 2 months that you have the equipment. Then there's a full year. It's only lasts 3 years, so that's full year. We've got 2026. You know, I'm gonna paste this over here so we have more space. Okay, then we got January again to December of 2026. Let's color this in green. So all this is every month basically during this whole period that they're asking about, right? And then I'll just copy this in, paste that, change the color. So I'm just doing the color so it's kind of easy to see. And then we can we'll just replace all our 2026s in this little section with 2027. Okay, so now we've got a full kind of life cycle of the whole thing here. And I'm just going to put purchase price. I'm going to say this will be depreciation expense. This will be accumulated depreciation. And then we'll put net book value, right? That's weird. Okay, so then I'm just getting, this is real world accounting. Let's use Excel to help us with this problem, which is really the most efficient way to do this kind of stuff. So the purchase price never changes, right? It's $18,000 forever. You don't make any adjustments to that. The depreciation expense per month, including November, because we said we bought it on November 1st, so that whole month of depreciation, each one of those we can do. When I do, if you guys watch me on Excel too, just FYI, plus and equals does the same thing, and plus is next to the 10 key calculator. So that's why you'll see accountants use plus most of the time as opposed to equals. But either way, it does the same thing essentially. So again, remember we calculated out that it's $475 per month of depreciation expense. So that is always the same every month. Whoa. We want my formula to pull that same number every month. Okay, so that's always the same. Now, accumulated depreciation accumulates, as the name would imply. So it'll be 475 plus another plus 475 plus 470. So this formula will just add another 475. It's saying this last month plus this month. That's what that formula is saying there. And we can just drag that down or fill it in. And so we can see a couple things. Maybe first off is that this thing has a 3-year life, but we've shown 38 months. So really this is beyond the 3-year life. This right here is 3 years. So we don't have any more depreciation in those months. So I'm just going to delete those 2 months out. And then remember the net book value equals the purchase price minus accumulated depreciation. And then again, it just threw out the whole thing. And so here you can see, the net book value is going down every month because accumulated depreciation is going up every month. Get rid of my decimals. It's cleaner to look at. Net book value is going down each month because accumulated depreciation is going up each month. Depreciation is the same over the full 3 years.
to get us to the full amount that we were going to depreciate, which is the purchase price minus the residual value. And then when you get to that 3-year mark, then you end up with a residual value of $900 on your books that will just stay there forever, essentially. So now what this problem is asking about is I'm just going to highlight the, color code these again. It's asking what is the totals per year, right, of the depreciation expense and accumulated depreciating balance, yada, yada, yada. So we can just kind of do that off to the side for annual totals. So if we want to know, so by year, I'm just going to kind of put it over here. So at the end of that year, right, we will have just 2 months recorded in 2024. Down here, I'll color that in. I'm going to go equals the sum. I'm going to do a sum just so I don't have to manually add plus, 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 plus. But you can do the sum formula and you can drag all that down. So basically, it's 12 times 475, right? Because that's monthly, it's 475, 12 months, 5,700. And I'm going to copy and paste that same formula in. So it just moves the formula, but we're adding 12 months together. I'm going to color code these. And you could definitely do this on scratch paper and all that kind of stuff. I just want to do it like this so you guys can really get a sense of like the flow and all the pieces and what you end up with over the life of a fixed asset or capital asset, what they call these. An asset like this is depreciable. And then the last one only has 10 months. The first 2 months were in 2024. The last 10 months, it's a full 3 years, but that 1 year is kind of broken out, because it was bought partway through the year in November in the first year. So then we end up with 10 months at 475 gives us 4750. And then, so that's our depreciation expense per year. And then the accumulated depreciation, you don't, for each year would just be what this ends at the end of that year. And then the net book value, similarly, is just what it ends up at the end of that year. So this should be all the answers that we need. This is how it all breaks down. Like I said, you could do it, you don't have to break out each month and do all this kind of stuff. You could just figure out kind of the first year only has 2 months, last month has 10, and then the middle 2 years, 2025 and 2026, just have, a full year, which is pretty easy math. So you definitely don't need to do this, but I think it's helpful to show just so you guys really get a clear idea of what's going on with these kind of problems. So, okay, let's switch back over to the homework and finish it out. Okay, so now we're back on the homework input section, and with all the work that we just did, in the spreadsheet there, we know everything. We've got it all ready to just input. So our original cost of our equipment never changes. That's the same. Our depreciation expense per year, we had that figured out. So 2 months at the monthly of 475 is 950. Then full year's worth is 5,700, which you could figure that out by saying 18,000 divided by 3, because it's 3-year life. That's pretty simple. And then the last year is 4,750, right? So you really don't need to do all the crazy, spreadsheet stuff like I was doing necessarily. If you had this problem in front of you, you could just go like, okay, I know the full year. I can divide that by 12 to get months. I know there's 2 months here and there's 10 months here. And so that's pretty basic math. But breaking it out in spreadsheet does kind of help just show the overall impact. So 2 months, at the end of you'd take to find the accumulated depreciation, you just take your monthly times 2. This was the first year we had it. And then at the end of the 2025, we've had 2 months here, 12 here. So you could take it by 475 per month times 14 at this point, and then add another 12 and then add another 10 of what you're multiplying it by. But we did the work just to show what it would be at the end in our spreadsheet. So I'm just going to break that out. And then net book value, remember, it ends up at the residual book value. And this is just taking original cost minus accumulated depreciation, right? Also pretty basic, but it's pretty basic, but I could, you can definitely get confused without understanding the components. So that's why I really wanted to show you in the spreadsheet there. Good. What did I miss? What's that? I do something wrong. Oh, sorry. I just copied over the accumulated depreciation. That was a mistake on my part. It should be 11,350. Cool. And there you go. That's all the homework. So this one's a little tricky, there's a lot of calculations to do. It's not rocket science necessarily, it's not crazy calculus or anything too difficult in math, but it's definitely something you have to spend some time ensuring how to get like the depreciation expense and calculate interest and all that kind of stuff. So make sure you study, make sure you practice. We'll keep practicing in class. Make sure you're staying up on everything. And let me know if you have any residual questions. And thanks, everybody. We'll see you in class.